Hey everyone, welcome back to Corporate Decoder. Today we're diving into American Healthcare REIT's latest quarterly report, and let me tell you, there are enough numbers in this document to make your head spin faster than a hospital gurney in an emergency room. Is this financial health or a code blue? Let's find out. American Healthcare REIT, they run a huge operation with all sorts of healthcare properties. From senior living to medical buildings, we'll be looking at how their properties performed, where their money's coming from, and whether they're keeping their financial house in order. Before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for you to share your thoughts. First, let's hit the high notes. We are going to look at the balance sheet. Think of this as a snapshot of what the company owns and owes. Real estate investments are the core, and they are at about $3.3 billion, down a bit from the end of last year. They have a decent amount of cash, around $86 million, so they have money to operate. Now, here is the big number. Mortgages and loans are around $1.6 billion. That's a lot of debt. Next, let's check out the income statement. This tells us if they're making or losing money. Total revenue, $540 million for the quarter. That's pretty good. But property operating expenses ate up a lot of it, clocking in at $432 million. When it's all said and done, they are still in the red, reporting a net loss of about $6.8 million for the quarter. The statement of cash flow will show how money is moving in and out of the company. Cash flow from operations is positive at $60 million, which is good, as that shows the business can sustain itself. Interestingly, they repaid $80 million on their lines of credit, which is a responsible approach and a good sign for the company. Now that we have the highlights, let's dive into the notes to the financial statements to understand what is driving the numbers and what risks may lie ahead. The filing gives a nice and simple overview. They are self-managed, which means they don't pay an outside company to run the show, and they focus on healthcare properties, which is a growing market with the aging population. Quick note, this is just a snapshot, so it does not have all the details of a full annual report. They talk about how they make money, breaking it down by services and payment types, so we know where the cash is coming from. It's mainly from residents and tenants. Here's a quick breakdown for you. Comes over time as people live in and use their facilities. The report states increases and decrease of assets and liabilities. It seems that some of the acquisitions and dispositions are not all cash, but part cash. This seems fairly complicated. Let's look at the real estate and how much it is worth. Buildings and other improvements are worth approximately $3.6 billion. But remember that depreciation lowers the value over time, so it's important to take that into account. They sold some properties at a loss. It looks like a little less than $500,000, which isn't material given the size of the company. Moving to their debt security investment, they have about $91 million tied up there. It's a way for them to make money from debt, but it also carries risk. They have intangible assets like good relationships with other companies, but these are going down in value over time through amortization. Here is a boring section. They mention they aren't in any major legal battles right now. Now, for the debt. They have a line of credit for over $1 billion, but only a little over half is actually borrowed. That's good. They have room to borrow more if needed. They use financial tools called derivatives to manage their interest rate risk, which makes sense with so much debt. I skip the numbers here for now. They are very technical accounting values and no large difference in values. If the numbers are negligible, then this is a nothing burger. Let's keep moving. This section will show how each part of their business is doing, from senior health to medical buildings. Here we can see what is going well and what is not. It's interesting to see the performance and profitability that's being used to decide the future of the business. Here's a quick highlight for integrated senior health campuses. They're seeing revenue around $423 million. The shop and triple net lease property segments were significantly lower, which might be the reason they're seeing significant changes. A lot of triple net leases expiring soon that the company must renew quickly. Again, skipping a large section as it only shows the same high numbers again. The company acknowledges that inflation has affected operations such that they have seen and continue to experience increases in costs. They use these things called interest rate swaps to try to keep their borrowing costs predictable. It can be pretty complicated, so they are trying to manage risk. One big problem, rising interest rates. If interest rates go up, so do their borrowing costs. This could impact how much profit they are able to make. Here's a new risk to keep an eye on: artificial intelligence. I didn't even realize that was a risk at all. It does make sense. Nothing major on the legal front. That's always good news for any company. Okay, after looking at the numbers, here is my take. American Healthcare REIT has a lot of moving parts. On the positive side, there's a clear strategy targeting the growing healthcare market, which is being bolstered by solid revenue in their senior housing facility. I like the diversified revenue strategy, but the business is also exposed to risk in the senior housing and skilled nursing facility market. However, the rising debt and interest costs are raising questions about long-term profitability. That net loss is a concern when compared to their large real estate holdings. In addition, the risks surrounding artificial intelligence and changing regulations is something to consider in the future. I would also look at what's causing some of these properties to perform better or worse, and if they are able to take that knowledge and apply it to the portfolio. Alright, that's our breakdown of American Healthcare REIT's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.